Financial decisions are often assumed to be rational, but research in behavioral economics and psychology shows that many choices are shaped by subconscious biases. These biases are automatic mental shortcuts that help individuals process information quickly, but they can also lead to systematic errors in judgment. Understanding these biases is essential for improving financial awareness and making more rational, long-term decisions. 2. What are subconscious biases? Subconscious or cognitive biases are automatic thought patterns, influenced by emotions, experiences, and environment, often outside conscious awareness. They simplify decision-making but can distort how individuals perceive risk, value, and outcomes. 3. Why biases affect financial decisions. Financial decisions often involve uncertainty, risk and probability, delayed outcomes. These conditions make individuals more likely to rely on mental shortcuts instead of careful analysis. 4. Common subconscious biases in finance. 1. Loss aversion. People feel the pain of losses more strongly than the pleasure of gains. Effects: avoiding beneficial risks, holding on to losing investments too long. 2. Overconfidence bias. Individuals overestimate their knowledge or ability. Effects: excessive trading or risky investments, underestimating potential losses. 3. Confirmation bias. People seek information that confirms existing beliefs. Effects: ignoring contradictory financial data, making unbalanced decisions. 4. Present bias. Preference for immediate rewards over future benefits. Effects: overspending, insufficient saving or investing. 5. Anchoring bias. Relying too heavily on the first piece of information. Effects: incorrect valuation of assets or prices, poor negotiation outcomes. 6. Herd behavior. Following the actions of others, especially in uncertain situations. Effects: market bubbles, panic buying or selling. 7. Mental accounting. Treating money differently depending on its source or intended use. Effects: irrational budgeting decisions, inconsistent financial behavior. 8. Status quo bias. Preference for keeping things the same. Effects: avoiding beneficial changes, delaying important financial decisions. 5. Psychological mechanisms. Emotional influence, fear, greed, and excitement shape decisions. Cognitive load. Limited mental resources increase reliance on shortcuts. Heuristics. Quick rules of thumb simplify complex choices. Past experience. Previous outcomes influence current judgment. 6. Impact on financial behavior. Subconscious biases can lead to impulsive or irrational decisions, poor investment choices, inconsistent saving and spending habits, increased vulnerability to financial mistakes. Over time, these effects can significantly impact financial well-being. 7. Strategies to reduce bias effects. Increase awareness. Recognizing biases is the first step in controlling them. Use structured decision-making. Apply rules, checklists, or frameworks for major financial decisions. Seek diverse perspectives. Consult others or consider alternative viewpoints. Focus on data and evidence. Rely on objective information rather than intuition alone. Slow down decisions. Allow time for reflection, especially in high-stakes situations. 8. Practical applications. Reviewing investment decisions objectively. Setting automatic savings to avoid present bias. Diversifying investments to reduce overconfidence. Questioning assumptions before making financial commitments. 9. Conclusion. Subconscious biases play a significant role in shaping financial decisions. While they help simplify complex situations, they can also lead to systematic errors and suboptimal outcomes. By increasing awareness and applying structured decision-making strategies, individuals can reduce the influence of these biases and make more rational, consistent, and goal-oriented financial decisions, ultimately improving long-term financial stability and success.